Hey there. Do you live in Westmoreland County? And would you also like to know what is going on with the local real estate market here over the third quarter of 2023? If so, then come on along. Hey, first, before we get started, if you have not already done so, if you would like to subscribe to our newsletter, head over to houserockrealty.com/newsletter, and there I'll be able to keep you up to date on different market updates, tips, tools, techniques, tricks, different things for your real estate to make your selling, buying, and investing life easier and better. Let's go ahead, get started. Hey, so first, what we're going to do is we're going to take a look at some MLS data. After the MLS data, then we're going to dive into a new app that I discovered several weeks ago that's really given me an opportunity to kind of take a closer look at things on both a smaller, more micro scale, as well as a more macro scale across the United States. But first, let's dive into this MLS data. So what we have here is I have the four main areas of central Westmoreland County. We're going to go as far east as Ligonier Township. We're going to cross through Latrobe, Unity Township, Greensburg, Hempfield, and end over at North Huntington, Irwin. And we're taking all four of those municipalities and areas and zip codes, combining them up. And this is residential data only. And what we have is we have two different graphs here. First, the blue one is the median days on market. And it goes back from January 2013 up through the end of September 23. Again, this is a third quarter market analysis, and it takes us right up to data that's only 1 week old. So this is about as real as it gets, folks. What you'll notice is for most of the last 10 years or so, Westmoreland County has primarily averaged about 60, 70 days on market. If you kind of take these data points and go right down the middle. And then the market, the economy was doing really good going into COVID. Interest rates were going down a little bit. People had disposable income. They were able to make investments, and the economy was moving really well. COVID hit, and several different things happened. Primarily, the first thing that happened is there was about a 3 month shutdown in the state of Pennsylvania where people weren't able to show homes. It was absolutely kind of crazy. People needed to buy and sell real estate, but none of that was really able to happen. So that's the first thing. The second thing, in response to COVID, is the federal funds borrowing rate basically dropped to zero, causing mortgage rates to drop really low. That the mortgage rates dropping really low allowed people to essentially be able to, quote, afford more home. So what might have been a $100,000 home quickly went up to a $110,000 home, $120,000 home, $130,000. It was able to quickly increase in value. I wouldn't necessarily appreciate, but it did go up in value, mainly just simply due to a change in the interest rate. And again, this inventory being taken off the market for several months. And speaking of inventory, before I forget, I do want to mention, if you're listening to media pundits, you're going to hear people talking about there is no inventory. This is not going to be the same as 2008. It's a completely different scenario. And there is still such a far shortage of housing. Let me tell you, there may be a shortage of housing in different parts of the United States, but there is not a shortage of housing in most of southwestern PA. There's plenty of housing. We're not having a large number of people move to this area. As a matter of fact, we're probably on a very slow, slight decline population-wise. So it's not an inventory issue necessarily here in southwestern PA. There might be a couple pockets such as Cranberry Township, South Point, Lawrenceville, different things like that. But in general, we had this shutdown of the economy for several months. We had the interest rates drop low. And then following the low interest rates, we ended up having 2 years of the largest inflation that we have seen. For many people who are watching this video, it may be more than you've ever seen in your entire life. But at least probably the last 30 years, we've had two of the highest years of inflation that for most of us, in any recollection of our memories, the prices have just skyrocketed. So all of that combined led to this rapid increase in home prices and what they were selling for, and this inventory being driven down because of the low interest rates. I believe there was a lot of speculation. I believe there was a lot of investment. People who People who weren't able to become homeowners before were able to become homeowners. Real estate investors were able to increase cash flow. Even if the prices were going up, their cash flow was still really good, and people were able to refinance. And with these increases in values, another thing that we saw was a, a basically people were able to refinance and in some cases pull cash out as well as set up lines of credit, so based off of this increased valuation of their homes. A lot of this is leading to what could potentially be a perfect storm. We'll get into that here more shortly, but what I want you to know right now, third quarter 2023, we are still at a very low days on market, strong sellers market. I can feel it turning on a week by week basis. It feels like is, and what you'll also want to take note of, last fall, the interest rates were creeping up very rapidly. They hit up into the 6.5%. What happened is the days on market it instantly shot up as we went into the winter. February 23, we were up to 60 days on market. We hadn't had that since back in 2019, which honestly was a normal market period for us. Back in 2019, things were kind of normal. They were really good, but it was normal in the sense of days on market. Then we quickly came into the summer buying season. That instantly again triggered this rapid buying and selling of homes and has us now to where we are here for these last 6 months, a low days on market. What's probably going to happen is, it looks like last November, the days on market started to go up, December, January, February. My guess is we're probably going to see something similar heading in the fourth quarter where the buying and selling, it's going to slow down a bit. The days on market will probably increase. And you also notice that this orange curve is your median listing price. It had increased, basically keeping pace with inflation for the last 10 years. And then all of a sudden, this rapid increase in values that we experienced. And Southwestern PA was not immune to that by any means. We saw it. People were doing highest and best offers. People were offering $20,000, $30,000 over asking price on a weekly basis. And not being able to buy properties. It was pretty crazy times. But what I want to do is I want to switch over to this new app, and I want you to take a look at that because it's able to show us some insights that we can't really necessarily see on some of this other data. Let's go ahead and switch over. Okay, so I'm here in this software. I found it several weeks ago, and I've been having a lot of fun with it. I kind of geek out like that sometimes. This one is called the RE Venture app. And what I want you to take note of before we kind of dive into the data, up here in the upper left-hand corner, it says the source is Zillow. And just so you know, Zillow's source, man, say that 10 times really fast, right? So RE Venture is using Zillow for its source. Zillow for its source is using essentially, for the most part, MLS feeds from across the United States. That data, that information, the availability of homes, pending sales, that is all flowing into Zillow through the various MLS feeds, which is generated by the real estate sales transactions by licensed agents and brokers across the United States. All that to say is pretty much what we're looking at is, for the most part, a lot of MLS data that's being compiled. And what I want you to take a look at is you're able to take a look at everything on a state level, metro, county, and zip. And we're going to start off local. And then what I want to do is I want to bounce out real quick just to show you a real quick snapshot of what the United States is doing on a year-over-year trend, because I think that's what's going to end up indicating Southwestern PA, kind of where we're at. So over here is North Huntington Township, Irwin, Hemphill, Greensburg, Unity and Latrobe, and Ligonier and Ligonier Township. And we'll start off here with Irwin. And what I'm looking at right now is the home value growth year over year. So we're going to kind of bring this up a little bit closer, and we'll see that again we had COVID, and then we had this rapid increase in values due to the interest rates as well as inflation. Those two things have caused a very rapid increase. We went from a 190 home value growth in August of 2020 to 217 in 2021. Then we were up to 230 by August of 2022. Yep, it dropped down, but it was still a 6% increase year over year, which is definitely more, as you can see from this chart, than what we're normally accustomed to. And then over this past year, 3%. So North Huntington Township and Irwin still seeing growth, albeit smaller, but I'd say it's probably on par with what it historically has done. Okay. So next, we're going to switch over here to Hempfield Township in Greensburg. We're going to take a look at the year over year home value and growth. It looks like we're pretty much 2 to 5% is what we've done since 2006 here in Hempfield Township in Greensburg up until 2021. 15% increase, 2022, 7% increase. Both of those combined was like a 22% increase, which is pretty, it's definitely high. But what you also notice now is year over year, it was only 1%, which is, as you can tell from this graph, it is a little bit on the lesser side from what Greensburg and Hempfield would normally be accustomed to. So there essentially has been some retraction, not enough to take away everything that has been gained over the last 2 years. But I think once we get into the 30-year mortgage rates, which I'm going to show you here in a couple minutes, that'll take a different viewpoint for us. So let's go ahead and switch over here to Latrobe and Unity Township. If we're going to take a look at the graph, we're at 12%, 4%, and whoa, Latrobe. What happened here? It looks like year over year, we lost about $1,000 in home value on the growth scale. So that is showing a sign of the hull of the ship potentially starting to show some leaks. What's the next year going to project? It quite possibly it's going to end up being down in the negatives, if I had to guess. We're probably going to be going down from where we are right now, but it's hard to say right now. I actually expected this summer for us to have some challenges, but we've definitely seen a drop, but it may or may not be enough to take it down too much further. Ligonier Township. What we have seen here is, again, 14% increase, drop down to 2, and then it's a negative 1%. So are we going, have we hit the bottom in Ligonier Township? Hard to say. But what I do want to show you is, let me kind of zoom out here a little bit. So if we take a look at this, basically if it's clear, you're kind of middle of the road. If it's blue, you've experienced some losses, and red, you've experienced some gains over the last year. And there's definitely some pockets that have had some good growth. Penn Township, any of you who are watching here for Trafford, Penn Township, very solid market, 4.8% that you had this past year. And one other thing I want to show you here before I switch off of this view, you can come over here, switch to the home value, and what you'll take a note of is we can come in here and take a look at the graph and kind of see, yep, we had a slow but sure increase, and then boom, it kind of went up. Side note, Seven Springs, I have no idea what in the world's going down there. I do know that homes were selling like crazy, and there was a lot of out-of-state money coming, but what's really kind of crazy is, like, during the recession, the 2008 recession we had, it didn't really even lose any value. It kind of held steady. And what was interesting is it kind of had like a slow decline for 10 years. And then all of a sudden, we end up having this crazy, went from 254 to $320,000 in 1 year, then up to 359. Now it's been a slight cool off. So that tells me, are those homes really worth $359,000 right now that we have there? Did a lot of people move there and drive up the demand? No. We definitely had lower interest rates, which allowed people to afford more home, as well as inflation. But even if we factor in inflation, it really doesn't push it that high. It was pretty crazy, the increase that we saw. Okay, let's go ahead. Before I show you the 30-year mortgage rates, so we can kind of take a peek at where we're going to potentially be going, what I want to do is I want to switch over here and let you take a look at a more macro scale of the United States. Okay, so in this view, what I did is I put home value growth year over year, and I have it on a county by county basis. So Pennsylvania, you can kind of really get a good idea of what might be happening. Eastern PA is still increasing. It's still going up. We have Harrisburg up 6.9%, Lancaster County up 6%, Westmoreland County as a whole up 1.5, Somerset up 1.4, but we're also starting to see some dents being made. Fayette County dropping a little bit, Bedford, Cambria, Blair, Clearfield, Jefferson, Northwest Pocket still staying pretty strong. Allegheny County's up 1%. Washington County mainly stayed level. Let's go ahead and take a look at the West Coast, because I think for us here in southwestern PA, we have our little bubble, we have our slow and steady, we have some ups, we have some downs, but we don't experience kind of what some parts of the United States are starting to experience right now. And if I had to guess, by the time we're a year down the road, where they're going to be at right now, it potentially has the possibility of getting really ugly for many Americans here over the next 12, 24, 36 months. Let's take a quick peek. Okay, so this graph is still county by county across the United States. And what we'll notice is West Coast, lots of blue. Blue means negative year over year growth. Texas, lots of negative year over year growth. Their values have gone down. Florida is kind of a mix. You got some red, got some blue. And what you'll notice though is northeastern United States, Midwest, staying very solid. They did not have the same crazy increases in values that some of the other parts of the country did. And what's really kind of crazy is whenever you look at some of these counties, like San Francisco counties, right now, let's see here. Here's one, negative 12% year over year. They went from 1.44 million down to 1.22 million. We have 1.6 to 1.5, and I know those are crazy numbers, but here's a county in Nevada, down 9%, went from 140 to 128, down 8%, 8%. Here's Las Vegas, down 8.4%. So the median house value has gone from 441 down to 404. And Texas as well, you're kind of seeing a lot of that same downward pressure. What does this mean? So we had people refinancing the low rates. We had equity lines being taken out. We had refinances. This large amount of cash was able to be refinanced, reinvested, buying personal homes, buying vacation homes, buying investment properties. To now all of a sudden, the values are starting to retract, go back down, and the people who borrowed those, they're not going to be able to sell potentially for the same price. They're not going to walk away with the same money. And in some cases, they might be completely upside down. I mean, could you imagine some of these places having to come out of pocket 50,000, 100,000, hundreds of thousands of dollars to be able to potentially sell your home? It's just not going to happen. I think the banks are going to have a lot of pressure on them here going into next year. And what I want to do is let's take a look at the 30-year mortgage interest rate. So if we go back down here, we were at 2.25% December of 2020. We're now up to 7.13%. And you're like, well, Brandon, what does that even mean? What it means, if we could take a quick look in here, 30-year mortgage rate. So if somebody was in a 30-year FHA, 2.25%, their monthly payment is $764 a month. Okay. Today, same $200,000, same 30-year mortgage rate, with a 7.13% interest rate that's being offered out there for an FHA loan, $1,348 per month. So the question that we have to ask ourselves, has people's incomes increased the same amount? So that is a 75% increase to go from $764 a month to $1,348 per month. That's a 75% increase in like 2 years. His people's incomes increased 75% over the last couple of years. Nope. They have definitely probably had some wage increases, and I'm sure that some of you might have had some crazy raises, and congratulations to you if that's been you. But for the vast majority, 99% of people, they did not have their salaries and wages increase 75%. So what is going to have to give? Well, the only thing that's going to have to give, so like if we go back to this $764 a month was what somebody could afford back then at that point in time. And let's say that they had some wage increases that maybe to the point that they're able to afford $850 per month. I don't know if they've had that much of an increase, but like, I guess 10% is not too crazy over the last 2 years. Let's say that's up to $850 a month. you're talking being able to afford probably like $130,000 home, or without doing the math, to keep it. Well, let's take a quick peek at it here just to see. I'm curious. Okay, so I just typed in $130,000 for the loan amount, 30-year fixed, 7.13% interest. That's 876. So it's not even that. It's maybe 126. There we go, $126,000. So the person who 2 years ago could afford a $200,000 home can only afford a $126,000 house today. And if those homes aren't there, they're going to make lower offers. They're going to wait until the offers or till the home values do come down. And how is that going to impact you and I, right? Because that's ultimately the question. So it's going to be interesting to see what happens and unfolds over this next year, 2 years, 3 years. It kind of feels like we're about to go into a really long turnaround process on the interest rates. I mean, let's face it, if we switch back here to the interest rates, to be able to get something back here, if I go back to max, you'll notice that through here, through a lot of the last 15 years, we've been able to operate at a 4% interest, or somewhere along there. And then we had this crazy period here over the last couple of years where the interest rates dropped down due to the federal borrowing rate going really low, up to now where it's like over 7%. What's going to be potentially happening? And I'm not sure if you saw yesterday, but the federal jobs report for September came out yesterday. They were expecting like 170,000 jobs to be added to the economy. It ended up being 330,000 jobs added to the economy. And we're like, okay, so what does that mean? What it means is we're still having high inflation. The Federal Reserve would like to see us at 2% inflation, year over year. We're still at like what, 3.8, 4%. We're still twice as much inflation. Yes, it's drastically reduced from, a year and a half ago, whatever we were running 10%, 12%. We're down drastically, but it's, primarily these interest rates are supposed to be what's driving that down. But the economy is saying it's still going strong. And until there's, not as strong of job reports being offered out there, the Federal Reserve may end up continuing to bump up the interest rate to continue to slow the economy down. It's showing that there's still some room where we could potentially bump up that interest rate to continue to slow that growth down because, again, inflation's still running high, twice as much as it should. People's purchasing power is being quickly eroded. So, all that to say, we're potentially heading into a several year period where the interest rates are going to be elevated. And at some point, people are going to need to sell, people are going to need to buy. That may impact what they're able to afford. And that may put some downward pressure on what those home sell prices look like. How much, how long, that's yet to be determined. Stay tuned. And by the way, just another quick reminder, if you have not signed up for the newsletter, head to houserockrrealty.com/newsletter. I will be sure to keep you up to date, putting out some great content, hopefully here over the next several months, to be able to keep you educated and informed and maybe even entertained. All right. Thanks a lot. We'll talk to you soon. Take care.